Hi, Planty is live in the studio. Hope you've had a good trading couple of days so far. It feels like it's quite well bid at the moment, and we'll talk through why. And obviously, we had a bit of China stimulus overnight. I've got dog friends who are coming to keep me calm, behave. So I thought a good idea, in case you haven't got any questions, hopefully you have, we can run through the preview. I think there's some really interesting charts in that for how we're kind of set up, which should play out over the weeks to come. But yeah, with the Fed doing what they've done, there's lots of commentary out there, and I've tried to pick out some of the more salient ones, more interesting ones. Hello, did you know game? It's an interesting name. What's that all about then? Is that game as in GameStop? Hello, James. Brilliant. ISL experience. Good morning to you. Good to see some people on board early. Right then. So what did you all think about the 50 basis points from the Fed? Did you all expect that, or are you looking for 25? What do you think is coming next? Discipline equals energy risings. What do you mean by that? Or oil coming back? Or... So that was quite interesting overnight with China. Hopefully you all saw that with all the different bits of monetary policy. They're trying to do the plunge protection team, which is the thing that was around in the US whenever they have a crash. Have people trying to support the system. And they're setting up a support vehicle. They're loaning out money to anybody that wants to buy equities and keep that going, encouraging buybacks, loans left, right and centre, reducing mortgage rates, reducing the required reserves. Every lever of monetary policy they've all done at the same time, which you can either read that as being panicky, or is it actually what you'd call inline coordinated monetary policy? It's quite good. I said last week that the States moving 50 basis points suddenly opens up opportunities for China. Now they need to spend on the other side of the equation as well, because at the moment you can make it as cheap as you want, but people aren't going to buy houses or the stock market. But it's all very supportive for overseas people, so it might help just get some of this sort of sewn in deflation to come out of the system. But meanwhile, what have we got in the US? So politics, as you can see, each day it's gridlock. They're both the same side of the same coin by the look of it, just Trump's a little bit more extreme. It's highly likely we've got gridlock. We've got the usual shenanigans coming up with, will they get their budget passed? And that will probably be used for a reason just to get the Republicans to ease off a bit going into the election, because most of those will want to get re-elected. So they should hopefully pass a budget, and that one won't be such a problem this year. But in the meantime, we've got rates easing. I don't know if you looked at the talking heads overnight, but Bostic was pretty much bang in line, saying don't read it into, call it a cadence, or basically a graph or a gradient of increasing rate cuts, but it's a good start. Super Dove Goolsby released every dove that he got in the coop and started saying that it's just first of many to come. And then we got Kashkari. If you remember, Kashkari was the plonker that sat at the back of the room, not on the voting committee, and made sure he was in the minutes for saying, but we've got to consider putting rates up, which when it came out 3 weeks after the conference and the result, the market spooked. If you remember that back in the summer. And now all of a sudden he's cut 50 and he's doing another 50, and it's as if it never happened. So he's done his usual Teflon man suit where nothing happens that I didn't call. So I said fiscal policy, half the world have been voting this year, and that usually means nothing gets done to fiscal policy. They don't stop the spending because they're all trying to get re-elected. So next year is supposed to be the time to rein it in. So is this a reason why the Fed are trying to become monetary easing quickly because they know what's to come, or is it just the fact that they're trying to get ahead of the data? And I'm kind of thinking that the latter. So it's all about, to me, the bond market. Everything that's come out is really kind of equity market supportive. Should see the pullbacks bought, should see a lot of the tied up money in the money markets come out. And we saw it, there's a chart in here which shows that. We saw the evidence coming out from the Bank of America movement of funds, flow of funds document that comes out every week. The City, the markets do look at that document every week. It's very interesting. So I think there's a backdrop to supporting equities. The bond market is probably overbought in the 2-year, and the 10-year is a bit mixed. Not quite sure whether these policies are going to be inflationary. So I think a lot of the volatility will come back in the bonds, and we do look at that move index for volatility. VIX, meanwhile, is retracing. We'll have a look at that. That's back to 16, which is pretty much risk on for a lot of the quant funds. But the first thing we've got to be aware of is getting through this next 2 weeks, which I've gone on about it. Hopefully been listening. You've hopefully seen it and heard about it yourself. But prior to August, Goldman's and JP Morgan had a couple of pieces out that we discussed. The Goldman's charts I thought were interesting. First of which is here, and it shows you the returns for every 2-week period since 1950. At the time, they were discussing how August is the worst return, and it's actually the worst positive return week. Period is the first 2 weeks of August. And a lot of people were looking at that for being a negative. We went straight into it with the carry trade unwind, didn't we? But it did end up eking out a small positive again for that, despite us being absolutely smashed in the first few days. But the key thing is that the worst 2-week period since 1950 is the second half of September, which is what we've just gone into. So we've got to kind of get through that. Now, a lot of this is tainted by the fact that it includes big recessionary periods where you have had big moves in September. And if they get stripped out, Ken Fisher at Fisher Investments recently did a video showing you that actually the second half of September is not that bad. It's flat to small up. So take it with a pinch of salt. And also this is a period where we've just gone for super loose rates in the States and super loose money in the problem area in China. So normally, as I said this morning, when you get global liquidity easing conditions, it's difficult to get negative equity returns. But like I say, we've got to eke through these next 2 weeks. I expect a little bit of volatility and see how we go. Discipline equals victory. One day I looked at the word morning and morning. They're spelt differently, but are pronounced the same. So I changed my morning greeting. Yeah, if you want to be downbeat, use the morning. Yeah. Are there any jobs available, even customer support jobs at Alpha? You're not really struggling. Sorry to hear that. Yeah, I'd kind of go on the Discord and ask. I mean, Alex, we lost the guy that was running it. I've been asking who it is that we should be sending details to. I mean, reply back to Alex or go on to suggestions on Discord. But try on one of the chats, and I'm sure somebody will tell you where to send your CVs and things. I just end up sending them to Alex anyway. But I am seeing him on Friday, and I'll find out exactly what we're doing and how many people we need, etc. So keep asking. So yeah, we're in a seasonally weak period, first 2 weeks, so keep that in mind. And also for the Russell, that is its worst 2 weeks as well. So we've had a lot of rotation, which is amongst the charts, which we're going to go through in a minute, showing that money has been broadening out in equities, and tech have seen a sell-off until last week, until really post the rate cut. A lot of the movement has been rotating, broadening out, which is what we wanted to see. So it's quite instructive that we've held the equity lows without seeing the leaders have the inflows. And now we're beginning to see that unwind a little bit more. Russell under a little bit of pressure and money coming back into techs. So keep an eye on that. So if that happens, we should start pushing on, because it'd be the heavier weights moving up again. And then there's a chart that we, on my chat, focused on when Fabo was around. He had a copy of this report. Now, when someone sends a chart out and January is at the left-hand axis and it goes all the way over there and December's still got a chart leading to the end, that to me means January starts where X and Y meets. And I couldn't understand why they were saying that August was weak, because on a non-presidential August year, the start of August is weak and then it recovers most of it. And then in presidential election years like we're in now, at the start of August, it rallies all the way up until middle of September. But the crucial thing again for seasonality is here, look, in the middle of September, in most years, since 1976 data, that tends to roll off. I don't like reports generally where they jump around from 1926 to today, 1950 to today, and then 1976. Normally means someone's trying to fit the data to their idea, but it's useful for us to look at because, look, in all the years, you get the October end of year rally, and particularly into elections. It's all about whether this stimulus coming now, whether that's brought forward the pullback to the start of October probably, and then a big breakout. So again, we're in a very short period for indices to blow up. We will have a look at where the dollar is. The dollar might not necessarily be as negative as we wanted it to be going into autumn, but it should still be supportive enough. And then you've got the things like stimulus today are just another helpful hand for commodities and gold and silver for their potential breakouts. But again, we'll look at the gold charts and there's every chance that it might just have a pause before it flies again. But at the minute, it's just incoming. The Goldman Sachs desk was saying overnight that they're seeing nothing but buyers. So it is hard to fight the flows, and we are dealing with a third wave there, which for me, I don't like really calling tops in it. But you just got to be aware that it has been part of this since November last year. So we're nearly at a 10.5 month rally for a big breakout wave 3 that's gone up 30%. Surely due some form of consolidation. Fed stimulus, blah, blah, blah. We talked about that. Boom, boom, boom. So just keep an eye on the seasonality. Now, the other thing is the hedge funds have been totally aware of the whole seasonality, and coming into this period, they're single stocks, and make your own mind up which ones they've been selling. They're at their maximum for a 2-year period in terms of short positions. This black line is a cumulative line. I think this is a Goldman Sachs prime book, isn't it? Yeah, I think. And so prime books are where hedge funds hold their positions. They generally hold them with a prime broker. It's cheaper. So one of the investment banks, etc. And they're coming into what is going to be a weak period, seasonally short. But just as interest rates have changed and money market flows are coming out, and then again, if you remember what we presented about a month ago when the August thing was happening, there was a really good report out there about quant funds that have huge amounts of money on there taking advantage of small movement trades, but they don't like volatility. And when they get huge volatility, they sell whatever the price, and then they'll come back in even if they're offside if volatility drops back down, which is what we were looking for it to get back below 20 on the VIX. That's happened. So I think you've got a potential here for 3, if not 4 big buys. You've got the stock companies themselves. Remember the big buybacks. It's not they're before third quarter earnings. So there's massive record buybacks for this year going on. You've got the quant funds potentially coming in. We've got money coming across from money market funds just as rates are getting smashed to the floor. And we potentially got hedge funds having to cut short positions. So even if you've got seasonality, it's being thrown against a walking wall of money, which is why I think we might end up with one of those, even from the overall seasonality, including the recessions, it's a minus 0.5% on average median return. So, it doesn't necessarily have to be a big negative. It might just be a small consolidation for the next 2 weeks before we move on again, October onwards. So just be very careful on this absolute shut your eyes, throw the darts at a dartboard short, because you might get whipsawed. And here we have it, the Bank of America outflows. They were trying to be a bit cheeky here, saying that the global wealth holdings for cash allocations is down at 11%, which was the trough period for cash in 2007 before we had the market crash and everybody went up to 21%. But look, in the 12 years since it was last at 11%, we've only gone above it twice. We've been in a downtrend. And if anything, I would argue we need to test here. We need to test cash holdings at 10% and below again before you trough out. So I think there's still that's probably about 2 trillion worth of money just to get back to normal levels of money market funds. So I'd be very careful of taking that on. And then, as we said, we've been rotating since, this data from Bloomberg and Edward Jones, we've been rotating since the start of July with equal weight S&P has been a big outperformer. We said the market could track sideways, not put a new all-time high in, particularly in that period, if there was more of a dispersion. We've just gone back to new all-time highs for Dow and S&P, just as we start to see some inflows back into tech. Obviously, NASDAQ almost flat. It's a semiconductor index that have been beaten up. Things like Intel, who have got their own issues, but they're even on the verge of having M&A. They might even get taken out or have investment. So some of this, and there's obviously the worries about the trade war with China that's caused people to move out of the semi space but stay in the AI space. And I think more and more that rotation will happen just to support the indices. And we saw the big move as part of this last week post the rate cut. Russell 1000 outperformed for a couple of days along with NASDAQ and S&P. So I think a lot of that rotation is in there, and we're going to start seeing, if we look at this graph in a couple of weeks' time, it'll start going back the other way. You can see there the Russell outperformance, but is that just part of a consolidation? It's got to take out its all-time highs for the move. It's been depressed. If we rolled out here, it's come off the big high. People would like to invest in this. This is normally, we've showed charts about this before. So I'll just have a look at the questions. Deep G, would the job be at Alpha, Capital Place or remote? It all depends what it is. They've got jobs in Newcastle, or there's usually some roles done remotely. Commies save the capital markets. Oh, the irony. Yeah, well, we've got that in the UK at the moment as well. So we'll see the proof of the pudding. But we'd like to see some stimulus applied to the markets when it's needed. Hopefully that is the case. If anything, we're putting insurance cuts in here, aren't we? Which we'll discuss in a minute. And that tends to see outperformance. But the Russell has been putting in a 3-wave consolidation. That needs to break out and go into a 5-wave, really. Otherwise, we're just in a fade from the top. Yeah, we're saying people want to invest in the smaller mid-cap area, but if there's a threat of recession, it becomes offsetting. So we need to see that really sent onto back burners. It all depends on the labour market, really, now. And the non-farm payrolls are just beset with revision problems. Forget the headlines. It's what keeps happening on the revisions. They did that 800,000 revision for the year in August, and each time, I showed it before, there's only about 3 out of the last 2-year reports have had an upgrade to any of the numbers. Generally, it's a revision down. So they need to get that sorted out. Once you see those sort of numbers change, you might suddenly start seeing people believe that the economy isn't going into recession. But at the moment, it's on a knife edge, isn't it? The PMIs yesterday in the States, weren't as much of a road crash as they have been recently. Employment is being held off until they see stimulus come in. Well, that stimulus has come in after the survey period for that report. There's a little bit of price pressure still in goods and services, so it's not completely blown up yet. But, we'll wait for the ISM, see whether those new orders have improved across the board. Within that, as I was saying, we are in a 3-wave consolidation. The Dow and S&P have gone to new highs, but the NASDAQ hasn't. It's just challenged the post-August the 5th bounce, which is this one here. We've come up against that on Friday, and again, we're getting close to a look at it again today. We've drifted off again around lunchtime, but that is the key. But within that, Mag 6 haven't gone to new highs individually, but collectively, the Mag 6 or Mag 7 index has done the same as the NASDAQ, and it's rallied up to Friday and Thursday and just tailed off a little bit. Meta's the only one that's broken out of its range of late, so there's plenty of room for the big cap techs to be supportive. Even Tesla's up today on reasonable numbers. So I was saying, with the Dow breaking out, everyone's rushing, all the mega bears are rushing to say, right, that is the final move. But with a lot of these things at the moment, I think there's a lot of what they call nesting going on. Janino, so Astro Gumbo, we've got global depression. Depends how you look at that. We have got sort of Germany and France holding down the euro situation, and they have downgraded. Obviously, we know, and I do think China is a problem if we don't get the deflation out of it. Then yes, things are asking to have stimulus. They've not gone into outright breakup yet, but there might just be enough in the system to just rescue this, and it end up being a period where we just got a little bit of support. I mean, this is what they're supposed to do. I don't actually mind the commentary that came out of Powell saying, I want to cut, but if things change, I'll put them back up. They should be doing that. Whereas for ages, a lot of them were saying, oh, we can't cut because we might have to go back up. I mean, this is good management, surely. But we'll see how it plays out. The new gold price, since it doesn't want to reach 2,000 in sterling terms. Yes, it is struggling to get through that. And I'm saying, I think short term, we'll have a look at that chart in a few minutes. But I think it will go through eventually. It's just all about currently, has it done enough? There's so many confluences from the waves that I look at. They're all coming together. It's overdue a sell-off, just as every man and his dog are saying it's completely one-way bet. I still think 3,000 is in play in dollar terms for the end of the year, and we've got to get through. Once we've got through this 2 weeks of seasonality for risk on and indices, we've got to get through the BRICS conference, haven't we, in October, which is going to come up with this alternative currency for settlements, which will include the dollar, will include gold. So we'll have to see how that hits the dollar and risk in general. But you never know, that might just be a catalyst for America suddenly sorting itself out. So in the Dow, to me, it looks like we've still got upside. We're in nesting ones and twos at various degrees, which means just like gold was back in February, there's still breakout to come there when all the threes cascade on each other. So is 45,000 going to be like the new big figure that everyone starts talking about in a few weeks? And S&P, remember, this is everyone's favorite, my super messy chart, but I just leave that in there because it has lots of info at the same time. And that, again, we had the equal legs wave 4 sell-off into September that we've been bouncing back from. Again, I'd expect that to be a 5-wave move, potentially hitting this 6,000 target. Might take till late October, November, maybe even into the election rally. But at the moment, I think we're going to put in a little bit more in the current middle leg before we retrace and then go again. Now, the reason why I think there's still a bit more juice is look at the 50-day stocks trading above their 50-day moving average. The peaks and the real exuberance comes when it gets to sort of 90%. At the moment, here it's running at sort of 30 above 50, sort of 75, 80. So still a bit more juice there. We were worried when this was happening, when we went into 200-day moving average below the 50 mark, and we said that I'd have to turn into a pattern like this to get worried about the bull market, and it didn't. It very quickly saw the 200-day moving averages come back in, and then the other thing that we were lacking was relative volume at the high levels. So that started to come back in to the market. So we are getting momentum, we're getting volume, and we're not necessarily extreme overbought levels. So the S&P, just because it's hit a new all-time high, doesn't, to me, say that that's the end of the world. I think we'll probably keep eking out some gains there. And this week's posting was the one from a couple of weeks ago when we just put the options in. We'd had the 3-wave equal legs move down, or it was a spot 786, wasn't it? And we said we'd have a bounce, and it's all about how this bounce plays out. Could we get to a breakout to go to new all-time highs, or would we fail? So far, we haven't taken that out, as we discussed, but we seem to be playing the first option, which was that we were going to nest. We'd put the wave 4 in, we'd have a breakout, consolidate it, and then we'd be looking to break again, rather than this was going to be a 3-wave to new lower lows and potentially the end of the world. Now, the mega bears, all they're doing is extending their argument that this is going to fail and we're going to go flying through the floor. But as I presented earlier, I think that the underlying liquidity now, and we'll be going into a period where I do think the heavier weighted techs will have reasonable upbeat data to provide us with, just at the time that it'll be the second quarter in a row that we've got broadening earnings growth supported by rate cuts. I think that they will just about hang on through that. They've already in advance brought down the rate of growth expected for Q3. So I think indices are well supported. And I would, again, October the 5th pullback is a long way away. I still expect us to hold within the current structure here. It'd be more 1-2 at lower degrees going again. And then ultimately, I do think we're going to put an all-time high. And I'm looking for a 22,000 print before we want to think about a decent consolidation. And that kind of shows you what happens in equities. They are supposed to be a discounting mechanism. If you were trading Germany on fundamental news alone, then you'd expect it to be at all-time lows. We actually put in an all-time high last week, despite the fact that Volkswagen are on the street saying they're going to have their first first closure of a factory in 80 years. The auto sector on its knees. PMIs yesterday, shocking. IFO drifting again today. You know, you'd be giving up. Now remember, China and Germany are quite well aligned. So if there does become any kind of momentum economically from China, that will feed through to Germany. So a bit of discounting ahead. The EU have set it up nicely, not doing too much before the Fed announcement, downgrading their growth outlook, but not changing their inflation outlook too much and not giving any dot plot, as it were, that like the States does. They've seen the 50 bips from the States. They've seen the 250 bips off by 2026, and they've got an economy that's proving itself to be blowing up. They will probably not do anything in October because they like to just give a nod to Nagel and his hawkish friends, but that will probably be exchanged for, if the data doesn't improve, it'll be 50 bips off in the November meeting, alongside potentially the US doing at least 25, if not a 50 print. So there might be some headlines saying that the data is bad enough for October. I think they'll resist that, judging by what the European talking heads have said. So we might get that short-term EU strength, but then they might get like the same with GU. As the year goes on, the data should deteriorate enough for those two central banks to play catch up. So commentary from the market about what they thought about the 50 bips. And a lot of them are saying, look, don't worry about the actual rate hike. It's all about the forward curve. And they've messaged the dot plot so well that the money markets are really up to speed. Everything's really priced in now for out to 2 years. And if anything, the 2 years gone a little bit too dovish. There's risk of that coming back. And just like in the same way, everyone's gone a little bit too hawkish and it's going to take too long for rates to fall in the UK. Yeah, a good trade would be those two, a swap between the US 2 years and the UK 2 years. So if anything, I think the Fed are, and as they're trying to do in the language we wanted them to say, talking about being up to speed or ahead of the curve just in case. And I think that's where they sit. Now, people who are critical of them, like people like Mohammed El Arian, remembers the fact they took so long to put rates up and they did 4 lots of 75 bips. If you've been in the markets over the last few years, that's quite unprecedented. They were having to play catch up, and starting with 50, that's normally, they only start normally with 50 when they're behind the curve. So people are interpreting it that they've got it wrong and that they're too late. But for the moment, we'll give them the benefit of the doubt that maybe for once they are on track. but we'll reserve judgment as it plays out. A lot of people saying this is a bit like the 1990s, where Greenspan got because they agreed to rein in the fiscal spending with the Clinton administration. There was worries that the market was going to slow down too quickly, so they decided to do a rate cut, even though the data didn't really ask for it. And they never got the recession, and the markets went banzai. And obviously, as we know, we ended up eventually in the 2001 market top. That was a big super rally, and we haven't even had that melt up yet in the current rally. So this could well be a repeat of the sort of 90s breakout, or even, as some people say, the 1920s super bullish phase, just where monetary policy became easy, and then we ended up getting to a euphoric top. But we're nowhere near that, despite the fact we're at current all-time highs. The rate of, if you look at any of the graphs, looking at where we are in terms of timing, duration, and level of the breakouts, we're still pretty mid-cycle. If you follow me on LinkedIn, and there's a chart of his in a minute, Jurian Timmer at Fido does some brilliant charts on past cycles, and he pretty much believes we're mid-cycle. So if anything, I would say they've gone early because they're getting so much squealing from everybody that helped the bailout of the banks over 18 months ago now, in March 23, SVB, the Silicon Valley Bank crisis. Everyone's been so underwater and really squirming. They've had to actually push back on the amount of reserves they were going to ask the banks to hold. That's been the sort of lectures that the Vice Chair Barr's been holding. I don't know if you've noticed those over the last few weeks. So this kind of rate cycle is definitely bringing people back towards being above water. Keep an eye on those Fed projections. They've moved. We're supposed to have an unemployment rate at 4% for the end of this year. They've conveniently moved that to 4.4. So that is telling us that we're going to get some more bad jobs data going forward. Most of the good economists will tell you that anyway. That's been the focus. That's what Dudley's been talking about, the former governor that was asking for 50 bips, saying that they were behind the curve. Once unemployment starts falling, it normally keeps falling for ages before it turns around, which is why they're saying, come back. Hello, Bletchley. Yeah, I did have a good holiday. Unfortunately, a lot of time. I've only just started doing these again because things have been getting in the way. But yeah, good to see you. I hope you're getting on all right. And obviously, that's not going to really improve until 26, 27, according to their data. Core PC, that's out on Friday. No, look, that is quite high. I think it's going to be 2.7, but it shouldn't be a jump beyond perception. Looking at the inputs we've had, if you know CPI and PPI, generally you know what PC is, so there shouldn't be anything that spooks there. GDP growth, that's a bit of a strange one, isn't it? Because they've got Atlanta GDP now, the data we asked you to look at, that predicts in real time after every piece of data. That's at 2.9 at the moment. I think we've got that in just below in a minute. And then that's the big one. Fed funds from the dot plot is in at 2.9. It could, I mean, obviously it could do. It depends how quickly it falls. If we're going to see GDP revised lower, that's the problem at the moment. That's happening, isn't it? Is that happening this week? It's a good question. I think that comes tomorrow, doesn't it, or Thursday? So just like we had those change in numbers to CPI, I guess a yearly revision. Then we just had the labour number, the non-farm payrolls in August, and that they were revised down massively. What Bletchley's talking about is I think they're going to revisit the GDP numbers this week from the income side to see whether it balances up. I think that is Thursday, isn't it? Yeah, well, we've got the GDP numbers on Thursday. I think they bring that out alongside it. So keep an eye on that, because that could, as you say, if the national income comes down, then it might cause a bit of ripple through the system again. So it's a count back. They measure it one way and then they get a measure back the other way as a kind of check and balance. So yeah, it was pretty unanimous, wasn't it? It was good to see Bowman put a balancing act in the Fed decision, but she voted for 25 and for numerous cuts for the rest of the year. So it was only a hands up to, I don't want to start at this pace. Waller had said, hadn't he, the week before, I'm not convinced for 50, but I could be convinced with the right idea. And Powell did a good job on them all. And he basically said that they were going at Jackson Hole, didn't he? Now, the interesting thing is, and I've got a chart on it in the pack, since the Jackson Hole, the economic surprise index has massively gone the other way. So again, it looks like an insurance cut. And have they gone too early, too quickly? So yeah, Eddie Ardini, I put that in there about he has and he was on Bloomberg talking about it yesterday. He got 50, 30, 20 for it being a 1920 style melt up or a 1990s one, or are we going to get a 1970s inflation double hit and a market smash? And he was 50, 30, 20, and he's gone 60, 20, 20. So he's sort of less 90s, more to the roaring 20s, just because their inflation looks like it's coming back. Inflation, if you remember, wasn't. They started off saying something they were unlucky with. It wasn't. It was transitory by nature, which meant it was going to disappear eventually. And remember, it was due to supply chains from COVID and supply chains from the Ukraine invasion. It wasn't like it was a problem within the system per se. It was a couple of shocks to the system, so they are working their way out. So it's highly likely we've got stimulus with lack of inflation. But net, I said, this is what happens when. What Bletchley's saying is China deflation an effect on global inflation? By definition, I think it has to be. They export massively. And this was one of the reasons I said months ago that if Trump starts putting tariffs up and China are desperate to just get some money back, they'll take hits. They'll export their deflation to the West. It'll come down to market prices then. It's all well and good what Trump's saying, but the punters will vote with what they buy. So that will, by definition, bring down inflation. And the danger to me is it becomes too big and that you see a big slowdown. You get positive correlations then across lots of assets, which again, China were desperate to be given room to be able to do something. That's the start of it all today, really. So hopefully they do get a little bit in. We'd like to see a little bit of inflation get into that Australian economy, just alongside a little pickup in mining activity, and then they get the double win, and hopefully they can bail out their mortgage holders. I mean, I think it was like Marie Antoinette from the governor of Australia, Bullock, wasn't it? Let them eat cake. Let them sell the houses. I don't care. We're not cutting rates before next year at best. So brilliant sympathy all round. Everyone will be doing a sort of a fundraising page for her when she loses her job, I'm sure. Anyway, post the first rate cut, and when they're done as insurance cuts, there we go, 95, 98. So 98 one was the LTCM crisis, 89 was recessions, 84 recessions. Look at that, 30% up 18 months later, and you are up by the end of the year. You'll be up 6 months' time. That's a number of weeks, isn't it? How many weeks are we to the end of the year? 12, probably 15, 18. So we've got a 10% rally coming, regardless, 8.5% on average. And then if they're doing it because you're in recession, then you tend to get the blow up. So the data going forward obviously is important, but normally they were doing that once you're in recession. We'll go and look at the latest moves on the gold chart. Like I said, I don't want to really try and call the top because it's a long-term wave 3, but it is from November 2023 where this wave started. And then we're dealing with subwaves of a fifth wave of a fifth wave. They're all getting extended, and fib relationships to me were suggesting that and the trend channels are suggesting that we had a very good chance of stopping in and around here. Now, obviously, if it's an extending wave, it could just keep running and running. But so I don't like to trade tops, but I'm fading the next move for the minute. I just don't want to be necessarily chasing it in what is normally a seasonally bad period for gold, the end of September. Once we get into October and beyond, then I wouldn't be fighting it at all. Excuse me, sort of dying here. And that's just rewinding that chart back to November. My minor 1 and 2 happened there, taking us down to 1916. We had the December pullback, and then the January. It's a February low, wasn't it? The February before we tried it was 1986, something like that failed, and then we're off to races. All these little 1-2s started building and breaking out. We got the June low for the fourth minute wave. So since then we've been in the 5th minute wave, and that's been subdividing. The minuet wave here is what we're currently in, and that's divided into 5. And it's just whether, as we said, we'll look at it in a minute, whether that has done enough for now. Oil again, we talked about over here a few weeks ago. It got a lower low. Any rallies were likely to be sold, and that again has been nesting 1-2, 1-2. Is this a 3 or is this another 1-2? Because it is in a third of a third wave at high degree. So unless this was suddenly about to go into a mega bull market for oil, I'd suggest that we've got a test at least down here in the low 60s before we get the proper bounce. So, Junio, you're saying in sterling terms, we're at a 25% delta. Yeah, obviously I'm looking at it in dollar terms. So, yeah, I haven't looked at that. How's that played out generally? What does it normally trade at, the relative? I mean, sterling, again, is rallying against the dollar as well, isn't it? So that should have been widening in currency terms. Aha, I didn't realise that was you, Kush. Okay. Yeah, it's because we told everybody, once you put that number up, then nobody would let you get through it, would they? It's coming, patience, but I just think it might just need a little pullback just to build the momentum for the next push. But currently, I've just watching it for the last few days. It's every time it pulls back to sort of 27.8, someone's back in, aren't they? It's and despite the fact that on the CME there's not really been a lot of physical buying like there was at the start of August. So a lot of that is getting done back door. I don't know if you kept an eye on and you probably have done with the Swissy imports and exports to China, etc. And wasn't it the Swissies that had exported to Saudi Arabia? On the quiet. So a lot of these guys push it through different accounts, don't they? That in the balance of trade, it should sit in a particular account that goes to the central bank account, and they try and push it through a different one, and it ends up sitting with another sub account at the national level. But that kind of tells us why we've seen physical demand without it necessarily going through the exchanges. Yeah, what do you think? What's our man going to do on his exit this week? Are we going to get 50 bips? Or is it just going to be 25? I mean, they've got the room to do whatever they want for his departure, haven't we? So this was a City Economic Surprise Index. And we've got to be, other things we've got to be careful of, the house price index. We've also got clearing going on in the permits, most houses being built. So that should be good for rents, supposedly, in the system. If you're suddenly taking out, a bit of a bubble on and a lack of supply. But the only problem is the owner's equivalent rent, the OER, the bit that goes through made up in CPI, does get based on real rents and estimated against the house price index. So if that is suddenly recovering as well, then the rent factor might suddenly come back into play in a few months' time. Just need to be careful on that. But as we said here, look, the Fed was saying that if they'd have seen the July data around here, where was it? Early August, wasn't it? So here into this period with the ISMs, then they would have gone. But ever since we bottomed out on the surprises, the data has actually come in slightly better. So that is where people are saying that they may have made a mistake. And the market is as sanguine as ever, as lacking in fear. Most of them are saying soft landing. No landing has gone down to 7%. Now remember, gold loves a hard landing because they know that inflation is going to come into the system. And don't think that it's just inflation, CPI inflation. What gold really likes is monetary inflation. So when this whole fiat money printing idea, and we're not getting any signs from the presidential candidates that's going to get reined in. And if there's a fact that they've got to suddenly mess around with a spike coming back in real, in consumer inflation as well as monetary inflation, and the total non-control of the issue, that's when gold tends to outperform policy mistakes, etc. So that could be another element why gold is seeing inflows. Well, the flat Zillow that's what's supposed to be feeding through into with a delay into the CPI, but it's not happening. I mean, we've got the small tick up this month, so they rotate the 2 6-month figures they use, but at the moment they haven't landed on the lucky balls that give them an estimated read through that actually contracts, and that's slightly worrying. Whether it's going to come through at all, but we need that sort of data to come through reasonably quickly. Otherwise, as we're talking about, some of the data will start rebuilding the other way. So soft landing, is it going to be the immaculate conception? So this is where the big argument's coming from for whether people want to buy equities into the year end or not. And when they were doing it in the 90s, like I said, they were worried about recession, but it wasn't coming. At the moment, people are interpreting that there's a chance of a recession with the way the job market is going, but it's still at reasonably strong levels. And they've now started to turn the wheel, but it will take a few months for that to have any effect, you would think, other than the fact the commentary you see in the PMIs said that people are waiting to make investments based on the interest rates. That's probably too late for yesterday's PMIs, but look out for next month. That could suddenly be quite a change. That will be obviously equity positive, but it'll be bond market negative. This is the chart from Julian Timmer, just talking about where the forward rate curve is, 2-year nominals versus how the dollar's been playing out. And that really is up to date with the dot plot a little bit on the 2-year, possibly 50 bips more if it went to a 1-to-1. And that equally for the dollar suggests that we only got a small further downside for this move, which I've been talking about being 98. So I think we might have a break of 100 down to 99 and a little rally, and then we sell off again. That's the pattern that I've been suggesting. We're building again, and lots of 1-2s. Someone on my chat today was suggesting they thought there might be a bounce to 1.5. Just because on the capital.com chart, none of the others showed it, that there was a liquidity grab, but we're not really basing that on any one particular CFD provider. we'll deal with the futures rate really at ICE, and I think that's still playing out before we get a meaningful rally back. For both GU and EU, again, I think they're in nesting situations, which hopefully they get their rally period in, 135 on GU, 115 maybe on EU, in amongst that sort of first bottoming out of sterling. Maybe there's one more rally after that, as we said, if looking at that picture, when we get this second and final fifth wave in, and then we'll probably see consolidation in GU and EU, but that we're talking an end of year probably for that scenario. UJ, for ages we've been saying, is this a double correction with a consolidation here in the middle? And I think we're consolidating at the moment, looking for equal legs into that 146.48 level. The way that they spell the dot plot out so markedly last week means that carry trade unwind, rather than panicking that we're doing 50 bips every month and 300 basis points are coming off by the end of 24. They've spelt out pretty much where they're going with it. It's 300 bips off by sometime in 2026, 27. Japan are only going to move in December, and in small rates if they can. So it just slows down that whole panic of moving back to pre-COVID levels on UJ, which is obviously 100. And in the intermediate time, we'll move towards that 130 level, I think. But short term, there's every chance we get a little further rally into UJ. So just keep an eye on that. If anything, we've taken away the whole carry trade meltdown, and we've sort of seen that in the flows in risk assets. To me, the whole thing, as it shows with the VIX, is that we're back in the period where large quant funds can put their money back to work. They love volatility plus or minus 1% or lower. They don't really care. And here we are. We've got the VIX. Remember, that's the weekly VIX with the spike. When we were above the trend channel from 22, we said we're going to come back in. We're hoping that to get us back down to the magic 16 number. Number 16 divided by the square root of 256. It's basically the number of trading days in a year. That gets you to what it moves on a day, which should be plus or minus 1%. This period here, when it's been there for a long time, flatline between 16 and 12, that's when we've had huge amounts of inflows and a market rally. Then stand by for the gush of the money coming back in from all directions. As I said, this is the one I'm expecting to be a little bit more volatile, and in the square channel, in the sideways channel there, is the bond volatility, because we're probably at extremes both ways on 2 and 10s. Expect those to kick every data ball a little bit more than the equity markets. So any other questions coming from all that? That is pretty much what I thought were quite useful charts that popped up looking just through my LinkedIn follow group really last week, and the CIS group put a lot of them together in a helpful thing that they do on Saturdays. It's always good for a catch up if you've missed a week. Look out for various CPIs in Japan. They've got their core CPI done by themselves, and the Tokyo CPI on Friday, PCE on Friday. You've got GDP data on Thursday. Mr. Jourdan departing, and the interest rate decision on Thursday, 25 bips expected. Have a look at Atlanta Fed, just see how everything feeds in. This is what I was talking about. Not only can you get the graph showing you how that's moving, this is more interesting, the way of following how the data pieces together. And they update it after each piece, and we've got one coming on Friday as an update. So you could see how, where were we? The whole Jackson Hole situation going into data around the period I went on holiday. It was back down at 2%, panic on. And then we've been bobbing around 2.5 all the way. And then we jumped up to 3% last week when the retail sales and industrial production were surprisingly higher. Housing starts were a bit flat, took a little bit off it, but it wasn't a disaster number that was expected. So that is Q3 estimate. And everyone, including the Fed, are talking about being back at 2% for the whole of the year. So we need to see things pull back a little bit for that to happen. What are the chances Japan starts cutting mid-long term instead of raising? I don't know, I have a feeling it's not sustainable. Well, history would tell you that the chances are quite high, aren't they? Because they've done it a number of times. But I got a feeling that wasn't the easiest path to take this time. It took a lot of effort to get there, didn't it? So the fact that they've broken the back with the unions and the wages, don't know. It's a whole generation of people that have never seen inflation. We need to see how they reacted. On the way down, when there was stimulus and things going and money around, they decided to save it. When there was deflation around, let's hope they decide to go, let's buy this before it goes up mantra. That's what we need to become endemic in the whole Japanese outlook. But there is, yeah, I agree with you. It's not a complete given that it doesn't fade away next year, particularly if I think they'll get away with it as long as we don't get this global recession into 2025. Luckily, it feels like the majority of people are grasping the nettle, and we should be able to come out of it. If the dollar still exists, that is. Earnings-wise, a little bit dull this week. Got Micron on Wednesday. That's probably the most instructive for the AI season to come. The rest of them are a bit dull. Accenture, again, that's for the bottom-up AI enterprise software angles. We talked about supply chain issues. Jabil will show that from Circuits. They have a lot of tech supply chain solutions. Friday, doesn't seem to be any results anywhere in the world. Monday, we talked about earlier, Bostik, Gouldsby, Kashkari. And then what we got today, not a great deal coming out. Bank of Canada might be interesting. SMB conference after their results, after their rate decision on Thursday. More talking heads. And it turns out that Powell testimony is going to be pre-written, pre-recorded. So I'd be surprised if there's anything decent coming out of that. Yellen's probably more interesting this week. Kashkari again. So as ever, there was last week's. And I've given you a load of links to what are some of them are quite interesting speeches, not necessarily market impact, but a lot of them go through the decisions that went behind the monetary policy, particularly in Europe. And obviously there's the whole conference speech from Powell, and the Bank of Japan one, and the Bank of England one. So there's some good nuggets in there of knowing where people actually sit. But yeah, so most of those, often they're quite super boring, but some of those actually got some, if you want to learn about fundamentals and how all these central banks think, then they're good starting points. And then you can come back with some questions if you find them. Well, one final thing from Kush. Well, I understand, I don't think they saved enough, protected themselves. They should. It is a global waiting game, and I think they play it pretty well. Normally, I call them bodge for a reason, because they do tend to mess it up. But they've waited quite well for the US to do its thing for them, and they can sit back now. And all the blame comes on the pace of rate cuts from the US. You know, they were getting blamed. I can't believe people were blaming Bank of Japan for the carry trade unwind. It was all about the US side coming too quickly, and now Japan can just pay to wait. The market probably gives them a few extra months beyond the end of the year, as long as they're still talking in the right language. But yeah, no, appreciate your questions and being on, sir. Anybody else got anything? Because got two things. We're about to start the US session, and I've got a delivery coming in 10 minutes, so I need to shoot. But as always, contact me on the website, and also don't forget the details are coming out in the next couple of days on the competition, isn't it? Remember, competition coming back October. Anybody can join. Manage a 200,000 account, and the top 30 players will receive a qualified account. No evaluation necessary. You'll be straight into the money game. So test your skills against the rest of the world. I do have to say, unfortunately, because of platform restrictions, Canada and US clients can't take part, but the rest of the world can, if you're not, as long as you're not in a banned country. So if you play by the rules and you normally get paid, you can take part. Any new potential clients, you can take part. You just have to sign up on the website when you know what the details are. So I hope you get involved in that. And if not, I will probably be back on Thursday this week because we're filming. We've got a filming day, something quite interesting. Pips and puts. Look out for that. We've had pips and pints. Pips and puts is coming. So, look out in weeks to come for some new content. We'll see you all soon. Thanks for taking part.